If you think dollar cost averaging is dead, you are using the wrong sentence. Dollar cost averaging is not dead. What is dying is the fantasy that ordinary people can keep blindly feeding public index funds and still expect to capture the fattest part of modern capitalism. Upside, that fantasy is dying fast, and most people have not even noticed. They still think the game works the way it used to work. Buy the index, keep buying every month, own the market, wait 30 years, everything important will eventually show up in your account. That story used to be strong enough. It is not strong enough now. Not because the S&P 500 is worthless, not because buying the market is stupid, not because discipline stopped mattering. It is not strong enough because the market itself changed. And most people did not. That is the first. I call it the diversification mirage. People say they are diversified because they own the S&P 500. That sounds intelligent, it sounds calm, it sounds evidence-based, it sounds adult. But a sentence can sound intelligent while hiding a much uglier truth underneath it. The ugly truth is this: when a tiny group of giant companies swells into an enormous share of the index, passive ownership begins looking less like broad diversification and more like a concentrated bet with a lot of decorative wallpaper around it. That is what has happened. The top 10 companies in the S&P 500 grew to nearly 40 to 41% of the index by late 2025, depending on the date and measurement you use. Faysite, Fayturn 778,706 search, 0 Fayturn 778,706 search, 8 Fay read, that again 10 companies out of 500. That is not the old fairy tale of perfect diversification. Most people still repeat to themselves while pressing buy. Maybe those 10 continue dominating. Maybe they deserve to. Maybe they keep compounding at a terrifying rate and carrying the whole machine upward. That can happen. But that is not the same as saying the risk disappeared. It means the bet got narrower while the marketing stayed broad. And that matters because most ordinary investors still think they are buying a balanced sample of American capitalism when, in practice, they are often buying a very large slice of a few enormous winners and whatever is left over. Now, I want to be very fair here. Buying the S&P 500 every month is still 1,000 times better than doing nothing. It is still better than most active managers over long periods. It is still better than gambling. It is still better than stock picking based on vibes, headlines, and a cousin's text message. I believe that. But the moment you say that, a crowd of lazy thinkers uses it as a sedative. They stop asking the next question: what part of the economy am I not getting anymore? That is where the second mechanism begins. I call it the missing growth problem. The public market used to be where ambitious companies showed up earlier in their life cycle. The growth happened with the public along for the ride. The great arc from promising to dominant was often something the ordinary investor could still access if he was early enough and patient enough. That world shrank. U.S.-listed companies have fallen dramatically from the late 1090s peak of roughly 8,000 or more to roughly the low to mid 4,000s more recently, depending on the count and year used. Faysite, Fayturn 778,706 search 9, Fayturn 706 search 13. Fay, that is not a cosmetic change. That is a structural shrinkage in what the public market even is. At the same time, companies have been staying private longer. One recent data series on IPO age shows firms going public at much older ages than they used to, while other recent summaries put today's median IPO age roughly in the low teens. Faysite, Fayturn 778,706 search 10, Fayturn 778,706 search 6A. That means a huge amount of growth that used to occur after listing is increasingly happening before listing. That is the piece ordinary people were not warned about. You open your brokerage app and think you are early. Because the ticker is new, you are not early. You are often late to the growth and early only to the public monetization of it. The venture capital firms were earlier. The growth equity firms were earlier. The private equity funds were earlier. The insiders were earlier. The sovereign pools were earlier. The wealthy families with access were earlier. By the time the company reaches your screen, the 10-fold and 20-fold phase may already be behind it. That is why I say the old public market fairy tale no longer maps perfectly onto the current architecture of wealth creation. The stock market is not fake. It is just increasingly the second half of the game. And if you do not understand that, you keep behaving as though the kindergarten version of investing is the entire curriculum. It is not. That leads to the third mechanism. I call it the exit liquidity trap. When a company stays private for longer, raises billions in private rounds, solves the ugliest scaling problems with private capital, and only then comes public after a huge amount of value has already been captured, the public investor is not entering the same room earlier generations entered. He is entering a different room. He is buying an asset whose early volatility, early asymmetry, and early upside have already been partly consumed by people who were allowed behind the first curtain. Now, again, I want to be precise. This is not a conspiracy sentence. It is a structural sentence. The capital stack changed. The funding ecosystem changed. The cost of being public rose. The availability of private capital rose. The willingness of founders to endure public market theater fell, and ordinary investors were left standing outside a door they still assume leads to the front of the building. It no longer does. The fourth mechanism is the public market burden. People love to say, if private is so good, why doesn't every company go public sooner? Because public markets are expensive, because public markets are distracting, because public markets are humiliating, because public markets attach a microscope and a quarterly firing squad to every strategic decision. Founders did not tolerate this pain forever because they loved it. They tolerated it because they needed the capital. As more private capital became available, a lot of ambitious companies looked at the cost of being public and said no. And why wouldn't they? If you can raise privately, avoid the quarterly circus, avoid the activist spectacle, avoid the reporting drag, and keep strategic control longer. That is not a hard decision. That is why so many of the best businesses never show up where ordinary people still expect the whole game to happen. That realization should make you uncomfortable. Good. The fifth mechanism is what ordinary investors still misunderstand most. I call it the two-market reality. There is the public market. That is where capital gets stored, protected, scaled, and compounded by millions of disciplined people who know how to wait. Then there is the private market. That is where a lot of the asymmetric wealth still gets born, shaped, bought, sold, and recapitalized before the public ever gets a clean look at it. These are not identical worlds. They should not be analyzed with identical expectations. The public market is still excellent for preservation and long-term compounding. It is still the right default for vast numbers of people. It is still one of the best wealth machines ever created for those who will not own businesses directly. But the private market is increasingly where the thickest edge lives. That is not hype. That is structure. And once you understand the two-market reality, a lot of modern financial frustration makes sense. The saver who buys index funds every month and still feels like the really huge wealth is happening somewhere else is not hallucinating. A lot of it is. Now, that does not mean everyone watching should suddenly imagine himself as a buyout artist. Calm down. The worst thing an average investor can do after hearing a truth like this is to abandon discipline and leap into a world he does not understand. I have watched people hear private markets matter and translate it into, I should buy random private junk, write checks into my friend's startup fantasy, or chase every illiquid opportunity I can barely explain. That is not intelligence. That is greed trying on a blazer. So let me say the hard thing clearly. The point is not that public investing is dead. The point is that passive public investing, by itself, may no longer be enough for the person who wants not just adequacy, but edge. That edge has to come from somewhere else. That is the sixth mechanism. I call it the ownership upgrade. Ordinary people still think of wealth as a portfolio problem first. The quietly rich often think of it as an ownership problem first. A portfolio is what you hold. Ownership is what you control. Those are not the same thing. If you own an index fund, you own slices of giant public businesses. Yes, good, helpful, sensible. If you own a private cash-flowing company, a boring services business, a local recurring revenue machine, a niche operator with stable margins, and an aging seller, you are no longer just holding financial claims. You are standing on the control side of the table. That is a different game. And in a strange way, the world of boring private businesses may matter more here than the glamorous venture world ordinary people fetishize. Everybody wants to talk about the next SpaceX. Very few people want to talk about the plumbing company, the HVAC operator, the pest control route, the cleaning service, the lab supplier, the niche distributor, the maintenance business, the dull cash machine with customers who keep paying because life still needs to work on Tuesday morning. That is where the quietly rich tend to think more clearly than the crowd. They understand that millionaire businesses are built as often from repetition as from innovation. And repetition is much easier to value than dreams. That is why I respect boring. Boring pays, boring survives. Boring can sometimes be financed sensibly. Boring often has sellers who care about continuity more than headlines. Boring may not turn you into a billionaire. It may do something much more useful. It may turn you into free. That brings us to the seventh mechanism. I call it the 2026 logjam. The private equity world bought aggressively during the cheap money years. Now many funds are sitting on assets longer than they planned. Exits have been slower, and holding periods remain well above old norms. McKinsey estimated that more than 16,000 companies globally had been held for more than 4 years by the end of 2025, and that the typical portfolio company was now being held for more than 6.5 years. Faysight Fayturn 778,706 search 7 Fay that matters, because when motivated sellers meet informed buyers, pricing changes, terms change. Creativity increases, structures appear that would not have been available in a looser, more euphoric market. I am not telling you there are bargains lying on the sidewalk waiting for anyone with a pulse. I am telling you that backlog changes behavior, funds need exits, older owners need succession, boomers are aging out of businesses. Smaller operators do not always want to sell to a faceless financial machine. Some of them want continuity. Some want their people protected. Some care about legacy. Some care about speed. Some care about trust. That creates openings, not for dreamers, for prepared people. That is a very important distinction, prepared people. This is not a message that says, throw away your index funds and go buy the first boring company you see. It says something colder. There is an ownership layer above passive public investing, and a weird combination of aging sellers, slower exits, and private market congestion means the next several years may reward those who learn how that layer actually works. Learning is the key word, not fantasizing. Learning the eighth mechanism is the seller, financing door. A lot of people assume private business ownership is impossible because they picture writing a giant cash check. Sometimes that is the wrong picture. Deals are not always solved only with one giant pile of your own money. Seller financing exists. Earnouts exist. Rollovers exist. Partnership structures exist. Search funds exist. Apprenticeship paths exist. Minority routes exist. Operator-backed deals exist. Creative but sane capital structures exist. Again, not magic, not fantasy, not easy, but real. And real is all that matters. A lot of older owners do not dream of selling to a private equity spreadsheet that strips cost and replaces culture with polished indifference. Some want somebody who will keep the thing alive if you bring trust, competence, and a plan. Capital is not the only currency in the room. That sentence will make some people angry because they want every opportunity reduced to cash alone. But the world is rarely that simple. That is why I keep saying the edge here is not only capital, it is knowledge and nerve. That is the ninth mechanism. I call it the small busyness blindness. There are millions of private businesses in America, and only a tiny fraction of American businesses ever show up in public indexes. Many of them are not glamorous. Good glamour attracts crowds. Crowds destroy edge. The ordinary investor scrolls right past the actual businesses that keep towns functioning and obsesses over public tickers everyone else can already see. That is backward. If you want to understand how quietly rich people often get rich, start by noticing what they own that the public never sees. Not always venture, not always tech, not always the next moonshot. Sometimes it is the ugly company with recurring customers, weak branding, strong cash flow, and an owner who wants out. That is not sexy. It is money. Now, let me be disciplined here and say what must be said. There is tremendous risk in business ownership, operating risk, execution risk, legal risk, labor risk, customer concentration risk, debt risk, succession risk, tax risk, personal risk. This is not a playground. This is not rich dad cosplay. This is not a channel for people who get bored with the index and need a more dramatic hobby. If you do not know how to read financials, evaluate working capital, understand customer churn, think about seller motives, or structure downside protection, you are not ready to buy a business. That is fine, but do not use that as an excuse to stay ignorant. Use it as a reason to get educated, because here is the real divide. The public index only investor often believes his problem is returns. The ownership-minded investor understands his real problem may be access to earlier growth, access to direct cash flow, access to control, access to the unglamorous businesses that never trend online but quietly mint freedom. That is why I say dollar cost averaging is not dead. It just no longer deserves to be worshipped as the entire religion. It is the floor, not the ceiling. It is the default, not the whole opportunity set. It is where you protect and compound what you have. It is not always where the fattest asymmetry begins. That is the real upgrade in thinking. You stop asking, should I abandon index funds? Wrong question, you ask. How much of my financial life should remain in the excellent but increasingly narrower public machine? And how much learning should I now direct toward the ownership worlds where a lot of the best upside now gets captured before it ever reaches the public? That is a grown question. And once you ask it, your behavior changes. You still keep buying the index if that is your core. You still automate. You still stay disciplined. You still reject speculation. You still build tax-efficient public compounding. But you also begin learning a second language: small business deal structure, seller psychology, cash flow valuation, simple financing, operational leverage, succession, search, hold, improve, own. That second language is where many fortunes are still being built. Not because the stock market is fake, because the game moved. The best players did not complain about it, they followed it. And if you want the hardest sentence in this whole piece, here it is. A lot of ordinary investors are not investing for wealth anymore. They are investing for adequacy. Adequacy is fine. Adequacy is civilized. Adequacy beats chaos. But if you want edge, if you want real asymmetric ownership, if you want to stop living entirely in the part of capitalism that has already been cleaned, packaged, concentrated, and sold back to you, then you need something more than automatic monthly purchases into giant public winners. You need an ownership upgrade. That does not mean recklessness. It means education. It means learning to see what other people drive past. It means noticing that a country can shrink its public company count, concentrate its index, delay its IPOs, clog its private exits, and still produce extraordinary opportunities for those who know where the money actually moved. That is the decision. Not DCA or no DCA. Keep the discipline. Lose the illusion. Because the illusion was never that indexing does not work. The illusion was that indexing still gives you first access to capitalism as richest growth. In this era, it often does not. And once you finally admit that, you can stop fighting the new map and start learning how to use it.